Hello, my name is David Das. Welcome back to my channel. Dividends are an important source of income for any shareholders. But how do you know if your dividends are safe? Considering that you have done your research, your proper due diligence, and you picked the right stock and you bought at the right price. But moving forward, how do you know that the dividends are safe in the future? This video will show you how you can check it out in 2 easy steps. And I will give you 2 examples, one for a Canadian stock and one for a US stock. This will apply for most of the stocks. For utility stocks, we generally have higher debt and more capital expenditure. We have to look at few different things. That's a topic of a future video. Same thing goes with the real estate investment trust or REITs, as they have bit different rules. Dividends are normally paid out from companies' profits. If a company pays more than it earned, then the dividends are at risk, unless they have a very strong cash flow or a large cash balance. The best way to find this is through a ratio called payout ratio, which is basically the total dividends divided by the net income. And this information is easily and freely available on any financial platform. Ideally, the payout ratio should be below 100%, the lower the better. The second item to check is if the company generated enough cash flow to pay its dividend. You can find this information through cash flow statement for most of the stocks. Cash is more important than profit from dividend perspective. So let's take 2 examples. One is the Royal Bank of Canada. I'm at the Yahoo Finance website and I went to the statistics tab. And if you scroll down, you will find the payout ratio, which is 48.33% in this case, which is actually very good. The next is the cash flow statement and see how much dividends they paid and compare that with the free cash flow. For the same Royal Bank of Canada, go to the financials, go to the cash flow statement, you look at cash dividends paid in the year which ended on 31st October 2022, they have paid $6.96 billion. And when their free cash flow is $19.44 billion. So obviously the cash dividends is a lot lower than the free cash flow. Now let's go to the Johnson & Johnson, the US stock, and we'll do the same thing. We go to the statistics tab and then we scroll down and we look at the payout ratio, which is 66.12% in this case. And if you look at the cash flow statement for Johnson & Johnson, in the financials tab, we're looking at cash flow and the cash dividends paid for the year ending 31st December 2022. They paid $11.6 billion when their free cash flow $17.18 billion. So we can see the cash dividends paid is less than the free cash flow. So this is also a good sign. If you want to take it further, if you think about it from logical point of view, you want the earnings growth rate to be more than the dividend growth rate. There are many ways where you can find the earnings and the dividend growth rate, but I'm using MSN Money in this case. I'm looking at the analysis tab of Royal Bank of Canada, and if I scroll down in the growth rates, 3-year average, the earnings per share growth rate has been 10.25%, and the dividends growth rate for the last 3 years average is 5.84%. This is a good sign, as the EPS growth rate is more than the dividend growth rate. I'm looking at Johnson & Johnson. I press the analysis tab and I'm looking at the growth rates for the earnings per share, which has been 8.92%, a 3-year average, and looking at the dividends growth rate for the last 3 years average has been 5.88%. So again, this is a good sign, as the EPS growth rate is larger than the dividends growth rate. I hope this video was useful. Thumbs up if you like it, and I will see you in the next one.